Have you ever wondered what an ETF is and how it can help you invest, and how to choose as few as 3 or 4 ETFs to create your own balanced portfolio? Well, thanks for joining today's InvestorWise journey. Let's dive in. ETF stands for Exchange Traded Fund. Picture it as a big basket of different stocks or bonds. Buying an ETF share gives you a little piece of each asset in that basket, allowing you to invest in a wide range of companies or bonds without having to buy each one individually. This revolutionary investment tool has made it significantly easier for the average person to dive into the world of investing. In the past, one had to open a brokerage account to get started, but today, it's as simple as clicking a button on your phone or computer. With ETFs, you're not just buying a single stock or bond, you're building a portfolio. And the best part, you get to choose how aggressive or conservative that portfolio is. That's a quick overview of what an ETF is, but let's go a little deeper. To understand the significance of ETFs, we need to go back in time and look at the history of stocks and bonds. The world of stocks and bonds has an intriguing history. Stocks, the shares of a company, have been around since the 17th century when the Dutch East India Company issued paper shares. Bonds, on the other hand, are a form of borrowing and have been around even longer, dating back to the times of ancient civilizations. For centuries, these two types of investments were the primary ways to grow wealth. Stocks offered the potential for high returns but came with high risk, while bonds offered lower returns, but with the promise of safety. This dynamic interplay between risk and reward has been a fundamental concept in the financial world ever since. However, in the past, the world of stocks and bonds was not as accessible as it is today. Barriers like lack of information, high transaction costs, and financial exclusivity kept the average household away from these investments. Investing was often seen as a playground for the wealthy, where they could increase their wealth exponentially. In the 20th century, things started to change. The advent of employer retirement plans brought stocks into the lives of everyday people. Suddenly, workers had a stake in the stock market, albeit indirectly, and with long-time horizons. Yet the world of bonds remained somewhat elusive, mostly confined to institutional investors. The advent of mutual funds in the mid-20th century made investing more accessible. These funds pooled money from multiple investors to buy a diversified portfolio of stocks or bonds, but they had their limitations: high fees, lack of transparency, and limited trading flexibility. But then, the investment landscape changed dramatically with the advent of ETFs, and we think that generally they offer the best options. So, what makes ETFs such an attractive investment option? Well, let's consider the details. One of the most appealing aspects of ETFs is their potential for diversification. By investing in an ETF, you're essentially buying a basket of different stocks, bonds, or other assets, rather than putting all your eggs in one company's basket. This spread-out approach can help mitigate risk, as the performance of one company or sector won't have an outsized impact on your overall investment. For instance, with just a few ETFs, you could create a balanced portfolio that spans across growth, value, and dividend stocks, with a safety net tied to core bonds. Another major advantage of ETFs is their low cost. Thanks to the broad and ultra-low cost index investing, coupled with the zero cost on trades, the financial barrier to entry is significantly reduced. This makes ETFs a cost-effective way for individuals to get their foot in the investment door without requiring a large initial outlay. Accessibility is yet another feather in the ETF cap. In the past, access to markets was not necessarily for the average household. But today, opening a brokerage account to invest in ETFs is a feasible option for many. This democratization of investing means that more people have the opportunity to grow their wealth and secure their financial future. ETFs also offer flexibility in terms of investment strategy. Whether you're an aggressive investor seeking high returns or a more conservative one looking for steady income, there's likely an ETF that aligns with your goals. If you've made it this far, consider giving us a like and subscribe to support our work of helping wise investors. We really appreciate it. Now, what if you wanted to build your own portfolio with 3 or 4 ETFs? You could choose a growth-focused ETF like the Vanguard Growth Index or VOOG, a dividend growth ETF like the Vanguard Dividend Growth ETF or VIG, and a core intermediate bond ETF like the Vanguard Core Bond ETF or VCRB. The choice depends on your time horizon, risk tolerance, and financial needs. ETFs have indeed brought investing within reach for many, but how does one go about using them? Well, stay tuned for our next scene where we'll delve into how you can use ETFs to build your own investment portfolio. Investing in ETFs can be as simple as building your own portfolio. Let's imagine you're putting together a jigsaw puzzle. Each piece represents a different asset class: stocks, bonds, commodities, and so on. Now imagine that instead of having to find and place each individual piece, you could just grab a handful of pieces that already fit together. That's the beauty of ETFs. Let's illustrate this with an example. Suppose you decide to allocate 1/3 of your investments each to 3 different ETFs: VOOG, which is the Vanguard Growth Index ETF, VOOG, the Vanguard Dividend Growth ETF, and VCRB, the Vanguard Core Bond ETF. The VOOG ETF provides exposure to large-cap growth stocks in the U.S., which can offer potential for high returns. The VIG ETF focuses on companies with a record of growing their dividends over time, providing you with a steady income stream. The VCRB ETF, on the other hand, invests in a wide array of high-quality intermediate-term bonds, offering stability and reducing the overall risk of your portfolio. Now, this is just an example. The actual allocation would depend on your individual circumstances, including your risk tolerance, investment goals, and time horizon. If you're younger and comfortable with higher risk for the potential of higher returns, you might allocate more to growth ETFs. If you're closer to retirement and seeking stability, you might lean more towards bond ETFs. Another way to increase risk and potential returns would be to add a small to mid-cap dividend growth ETF like VFQY or the Vanguard U.S. Quality Factor ETF. This ETF focuses on smaller companies with strong fundamentals and a commitment to increasing their dividends over time. The beauty of this approach is that you're not just investing in individual stocks or bonds, you're investing in broad sectors of the market, diversifying your risk across hundreds, if not thousands, of different securities. And there you have it, a simple way to create a diversified, low-cost portfolio using ETFs. Remember, the key to successful investing is to understand your investment options and make informed decisions.